Good morning. My name's Paul Nicol, Managing Partner of GFM Wealth Advisory. Joining me on today's podcast is David Leslie, who is the Investment Director of the Ellerston JAADE Private Assets Fund, and Sam Eley, who is a Senior Financial Advisor at GFM. Today, we're going to be discussing the Ellerston JAADE Private Assets Fund, which is a foundation investment in our GFM portfolios. Before we get underway, today's podcast is general in nature and not specific to your circumstances and should not be considered personal advice. Morning, David. Morning, Sam.
Morning, Paul.
Hey, Paul. Hey, Sam.
Hey, David. How are you?
Good.
David, very keen to get into the nitty-gritties of the portfolio position in the Ellerston JAADE Private Asset Funds. But Before we do, I'm just keen for you to explain what private asset or private equity investing is and why you think investors should be allocating to private assets or private equity.
Okay. So the easy part is I think everyone's very familiar with listed equities, Australian listed equities, global equities. So, clearly we're not publicly listed, publicly traded, private companies, different forms. You've got in the private asset class, you've got things like property, you've got things like infrastructure. Then you get into sort of, where we operate, which is minority stakes in Australian high growth companies. So where it's probably getting a bit more into the nitty gritty of private equity, you've got investors who take control. So traditional leverage buyouts, the likes of the KKRs, the Blackstones of the world. And then at the other end of the private market, you've got venture capital. So people putting small amounts of money in wide portfolios, looking for those sort of 1 in 100 type outcomes. We're at a growth stage. So as a growth stage investor, we're investing in businesses that typically have 10, 20, $30 million of revenue at least, if not bigger. And we're buying minority stakes. So, private capital, as far as we're concerned, is that growth stage. You're providing capital to drive the growth, maybe some liquidity for the company and founders. But fundamentally, these are businesses that are established, have good unit economics, and we're leaning into providing capital to help them.
Okay, great. And David, can you tell us a bit about what characteristics you're looking for when you're evaluating companies for the JAADE Fund?
Yeah, so there's a little bit of maths that goes into every valuation. We run a scorecard, and we're looking for revenue growth rates, typically north of 30%. We're looking for businesses that have good unit economics. So whilst the company may not be profitable in the stage of life that we invest at, we're definitely making sure that the marginal dollars are generating a positive return. We're looking for businesses that have got long duration growth profiles. So, we don't want businesses that maybe have a COVID style event where it might last for a year or two, but we're looking for structural growth and businesses that we think can grow for, 5 and 10 years because they're the ones that will get the larger multiples. We look for other characteristics like large markets, good gross margins. But I guess the biggest characteristic we're looking for is founders, management teams who we feel we have chemistry with because, we're only going to be in 10 portfolio companies in our case. So you have to have relationships, feel you're going to be listened to. And, you want to be totally aligned to where you're taking these businesses and where you're going to have the opportunity to get on the bus as well as where you can get off.
Yeah, absolutely.
So in the period that you've had the fund, David, one of the major differentiators that I've noticed, perhaps compared to other private asset funds, is the fact that you guys seem to get very actively involved in the companies that you invest in.
Yeah.
So I guess it's a question of two parts. Firstly, is that still the case? Are you still very actively involved in these businesses? And how much value add do you think you can add being actively involved?
So I guess being concentrated, 10 portfolio companies, there's about 10 of us in the team, including some operating partners that we have. So it's a fairly high effort in terms of, the due diligence process and evaluating and getting involved. At the time, we put together a plan. So then it's really clear from the company's point of view and our point of view what role we're going to play. And in each company, it can be a little bit different. But fundamentally, there are operating partners who've been CEOs who might be just good at mentoring the founders. Now, don't forget, we're the minority shareholders here. So we're already always sitting there and saying to the founders, we're not here to tell you how to run your business. But I tell you what, we've seen a few of these movies before. So there's a few, tips and tricks and, helping to keep them focused. But I think overall across the portfolio, if I look at a couple of the more recent investments where we're getting involved, one of the things increasingly that people value from us is that there's a sort of playbooks around, all right, having made an investment, There's going to be more capital markets decisions that are required. So there's going to be additional rounds of capital. There's going to be exits and realizations. And I think we're really, as we go through more exits in the portfolio, one of the things that we're spending even more time on is focusing on that exit muscle and how we're going to help companies with those realization events. Now, if you're a founder, you've built your business, you only really get one shot at an exit. So we like to spend a good bit of time talking to them about how we can help them with the business, but we spend a lot of time saying, look, we actually have genuine expertise in helping you to plan for your exits and the ultimate realizations.
With these founder-led businesses that you have, David, so how do you sort of avoid becoming emotionally attached to the businesses and the people that run them? I imagine you probably have to have some difficult conversations along the way.
Yeah, and there's no doubt there is you're dealing with people's lives. You're dealing with people involved. There is a level of emotion that surfaces. Especially from a founder's point of view.
Yeah.
And we're trying to build warm relationships to be trusted, and that means you've got to invest a bit of yourself into these transactions. But at the end of the day, as a fiduciary responsible for generating outcomes, you've got to have respect for the fact that you're dealing with people. But I think, that's sort of different from being emotionally attached to making the right decisions. At the end of the day, it comes back to, aligning with everyone involved and introducing, whether it's incentives, rewards, whether it's putting more money into companies. I think a lot of the times when we're trying to overcome some of that emotional angst, where a founder's maybe got a business to a point where maybe their risk appetite is diminishing, maybe they're fearful that they're not going to get anything out of it, we can bring to the table, one, our experience, but also we can say, look, we can help to solve some of the emotional things. Maybe it is about bringing someone in to be a CEO, to be a partner with the founder, to change the management team that they maybe love and trust. So look, we're going to put some more money into this because we think the North Star is out here. To get there, you're going to need more capital, more capability.
Yeah.
Doesn't diminish your role and your influence over the business, but we try to, there's absolutely an element of, putting your skin in the game and no one wants someone just to sit there and be critical the whole time. Being constructive, providing solutions, and in our case, using capital selectively to solve problems. When founders are obviously, generally all in on where their businesses are, I think there are ways. At the end of the day, we're solving for the best returns for us, for our investors, and we keep telling the founders for them and their shit, they're all in on their wealth on the business. So just keep making sure everyone understands how aligned we all are as we go through.
Yeah, great. So keen to get into the nitty-gritties of the portfolio.
Yep.
From the outside looking in, it looks like it's been a really busy 12 months,
Yeah, it
David.
has been.
Yeah.
The last 12 months, there's been 2 exits. So we sold Focus, which is a business that we'd sort of had for 4 or 5 years. We ended up exiting all of our SiteMinder shares, which a company that listed a couple of years ago. And I think we'd always been clear with our investors that, if we found a better use for that in private companies, we would realize that. And we did that over the recent months. But we've also made 3 investments this year, but over a 12-month period, 4 investments. And so the volume of activity, the quality of deals that we're seeing, and I think the distinctive thing about the portfolio companies, particularly the last few months, is we're seeing larger, more scaled opportunities where we think the returns are more obvious, right? So in some of these later stage businesses, you can often attribute them with having less potential returns. But in these cases, we see not only good base case of the returns, but also a lot of potential upside if some of our thesis plays out. So quality of deal flow and activity is definitely on the up, and there are some big investment thematics that have really come to the fore.
So you're saying the catalyst has been that the mid-market, which has been a period, an area of the market that you've been willing to cultivate, that you're moving up the scale a little bit to later stage?
Yeah, and I think as our fund is growing and maturing, and I think, as companies, founders, participants in the market are recognizing that what we offer is a little bit different. So, we sort of talked about private markets before. You've got the pre-IPOs, convertible notes, people who want a listing in 6 months. We're happy to do that if it's the right thing for investors in the company, but we're more patient than that. So we're looking at those 3 to 5 year journeys. So I think we've been able to have 2 particular conversations where the founders have chosen us as their partners because we bring a certain patient type of capital, where, all those things we talked about around alignment and whatnot really resonates with them. So in some respects, when people see the track record of success that we've had over the 7 years, it actually gets a little bit easier to step up and pay. And frankly, we're not doing, this isn't the well-trodden ground of Australian markets, right? There's still a very big bias towards those change of control transactions. So often we're saying to founders, don't do a change of control now. Continue to maintain control, take some capital for us, and let's drive that growth in your business before you have that ultimate realization. And that resonates.
Considering the level of portfolio activity, are there any sort of high-level trends or challenges that you're seeing in the private equity market?
Oh, look, I think everything you read about private equity is that there's this a lot of dry powder and a lot of private equity managers who are looking for realizations as well. And I think what you're seeing from private equity is they're not going into it. The IPO market's not flush with brand new deals coming out. And then on the sales side, you're seeing a lot of the big private equity funds doing these continuation and extension funds. They've got a good asset in the portfolio. They'll find other sources of capital, continue to retain it, and carry it on. I think one of the things, again, because of the stage of life that we're at, we like to think often we're the first institutional investor in these companies. We're early on in the journey. So I think we've found it easier to get realizations than the average private equity investors. And so, sometimes in life, you've got to cross the spread. You can hold on and try and get an amazing outcome, or you can sort of meet the market. We've had 3 investments over the last sort of 2.5 years. So I think if there's a challenge out there, it's, we're at a stage now with the fund where we've got great portfolio companies, but, there's always, if we can exit the ones that aren't going to be our best performers and hold on to the ones that are going to be our winners, that's always front of mind. But you would expect to see that regular cadence of realizations, and we've been really focused on that.
Yeah, looking at those new portfolio positions, Fresh Clinics,
Yep.
Sleek,
Yep.
Firmus,
Yep.
Yochi,
Yeah.
just reading about these companies on paper,
Yeah.
they look to be of just absolute quality. And it
Yeah.
appears to be like there's a real quantity of this quality that's available. So you're feeling like without being derogatory to companies that you do own or own previously, but these just look to be very exciting opportunities.
Yeah, there's some, in each case, there's some very specific tailwinds. There's different themes behind all of them. There's probably a slightly overriding, theme across the portfolio around AI. And, I think every AI is something we can sort of dive into, but that's the overriding, most powerful theme that I've seen in investment markets for a very long time. But if you look at with each of those new companies that we're involved in, I think the experience that the team have had in other investments, we would never have got involved in Fresh Clinics if we hadn't have had Mable. Mable taught us a lot about those disruptive healthcare technology models. And so Fresh Clinics, which started life in cosmetics, has now moved into weight loss. It's moving into menopause treatments and other areas of discretionary healthcare. We've got playbooks, we've got capabilities, we've got the founder from Mable actually spending a lot of time with the founder from Fresh Clinics. So there's a lot of cross-pollination going on. So, experience does inform a lot of your decision-making and how you sort of look to invest. And definitely, we're finding things, but I think we also recognize more quickly. The pattern recognition we're getting better at. So I think we're quicker to move. We're quicker to probably go where others have still got reservations because of some of the positive experiences that we've had.
Is that something you try to engender, David, that cross-pollination between some of the businesses where you see sort of similarity or an ability to get one business from there to there?
If you go to the US and you visit with the biggest private equity managers in the world, they have these awesome, they're running many billions of dollars of capital and they're, for control investors in particular, the leverage buyout guys, they're great at bringing them all together on a quarterly basis and they get, all the sales guys in one room, they get all the technology guys in another room. We're a tiny fish in the world of private equity, but we're learning from that. And so we do a good job of getting the CTOs, the CFOs, so we're sharing ideas. But where you've got businesses that actually have very, the pattern recognition's really high, like Mable and Fresh, we go to the next level to try to facilitate that again. So there's common board members, so myself and Jane, who you guys have met a couple of times. Jane's obviously a nurse by training. She sits on the board of both Mable and helps me as well with Fresh. And so, we're trying to leverage our own success and experience into the investments we get involved in.
You might have touched on it a little bit before, but is there a particular thematic or company that you're particularly excited about?
Yeah, look, I think the biggest investment that we've ever made as a first-time check is in Firmus. And Firmus is an AI factory. Firmus is a business that we first met around about 2020 when Ollie Curtis, as an entrepreneur, was trying to take advantage of the Bitcoin opportunity. So he originally went down the path of going, how can I produce the lowest cost, Bitcoin manufacturing? All right, so I need to get access to energy. I need low-cost computing. All right, one of the inputs is cooling the chips. So he came up with immersion technology. So basically, putting the rather than air cooling, using fluid to keep the chips cool and run them at a lower temperature. So to his credit, he ended up building a AI factory, or he built an AI Bitcoin mining capacity in Tasmania.
Mm-hmm.
Bitcoin mining, when we looked at it, we're not here to speculate about a Bitcoin mining price, but we liked what he was doing. So we sort of followed his progress. He went up to Singapore. Then he ended up working with a Singaporean group, STT, that was backed by the Singapore government, and basically replicating the capability, but this time running it as an AI compute solution, so an AI cloud solution for a large global hyperscale customer. So what Firmus had created was this ability to run the NVIDIA, AI generating chips in a way that used energy more efficiently, and that got NVIDIA's attention. NVIDIA, 90% of all of the AI chips in the world, are their design. And so, fast forward now to where we get re-engaged with the company, NVIDIA walked around and said, we're going to invest in this little Australian business. They've proven that they can run with 100% uptime this capability in Singapore. They've got this great site in Tasmania, which they now want to fund, which is going to produce, because Tasmania is all hydroelectric, so renewable energy. So they're going to produce green AI tokens, so green AI compute. When we saw, what, a $4.5 trillion US company, the biggest company in the world, what are they doing hanging out with this tiny little Australian company? And so because of, and again, at Ellerston, we have colleagues who are investing in listed markets. The whole firm got around this idea. And so we were then doing research on, all right, so NVIDIA backed a company in the US called CoreWeave. They've invested in Nebius. So we're looking at the patterns and the investment rationale for what they've done in markets around the world. To NVIDIA's credit, they then sat down with us and explained to us, why they saw value in this, what they call the bottom of the stack technology that effectively Firmus introduced that enabled them to produce these AI tokens more efficiently than others. We became kind of convinced, but still it seemed a little bit of a long shot, because as you're building these centres, not only do you need a bunch of equity, so in this case they were raising $300 million Australian, but you need billions of dollars of debt. So there was still, in these very early conversations, all right, there were risks around, all right, how's this going to work? The site, we've got one in Tasmania, we've got to get chips, NVIDIA's going to supply them, then we need to find customers who are going to take that. Oh yeah, globally there's this epic demand to build these AI, to use AI. But at the time when we did the investment, we could see that, particularly with NVIDIA's help and with what Firmus brought to the table, the capabilities were there. Now, when we made that first investment, our level of confidence, it was obviously material for us to write a big check. But the pace with which it continues to evolve, and the more that I learn about AI, we're in this first innings of where AI today is solving a lot of digital problems. So the sort of problems that in many of our businesses, financial services, we're using AI to improve the way we do things. But there's this world of AI which is being applied to sort of, social media, digital businesses, but there's going to be a physical AI world as well. And so the appetite to run larger models to deal with more complex kind of AI compute is still really rapidly evolving. Hence, NVIDIA's share price continues to perform really well. What has since happened in the last week, and I'm sorry, I'm getting a bit excited, so I'm sort of jumping a long way into the story. So in the last week, they've now announced that not only have they got the site in Tasmania, but they're now partnering with the largest provider of data centres in Australia, which is CDC. Now, CDC's biggest shareholders are Infratil, which is listed, but also the Future Fund. So you've got in the Future Fund, the largest sovereign investor, the Australian sovereign investor with long-term patient capital who's underwritten CDC building out future sites. They've now aligned that future sites and that capacity to make it available to Firmus so they can then go in and buy the chips and provide this AI compute scenario. NVIDIA, meanwhile, says, yep, I'll be a customer. And what NVIDIA being a customer says to the whole world is, these guys are investment grade, their technology works. And so then the conversations are now starting with some really serious global hyperscale, the biggest tech companies in the world. So AI as a theme and as an application touches every one of us. You've got 800 million people around the world who are already using ChatGPT and the take-up's phenomenal. AI infrastructure is a more interesting layer because the way that AI infrastructure is sold is you get these 3 and 4 and 5 year offtake agreements where you're building infrastructure, but you're almost getting a regulated return. Not a regulated return, but you're getting a guaranteed return. And so over an offtake period, and then you've got outer years where you get to use and improve the returns. So when people talk about AI, there's the software, the business models, the applications of AI, but the investment in Firmus, which is at the AI infrastructure level, to us, and it's evolving very quickly where the credibility that Firmus has means that they're going to go a lot faster than we probably thought that they would have when we first made the investment, means I think there's going to be a very high and a very fast return that we can potentially get out of our investment in Firmus.
Yeah, so there's clearly data centers in Australia, David, but at the moment there's no AI data centers. So data centers specifically for that AI compute. And these guys seem to have.
So what happens is when Amazon, AWS, when Google turns up, they have all of the capabilities, but they then design a product where they then take that real estate in the data center, they buy the chips, but then they sell it as a AWS cloud service. Yeah. And what NVIDIA's clearly decided is, they want to have a wider world of people building AI tokens, AI capabilities that's a bit unfiltered by maybe the services that AWS or others are looking to offer directly into the end users. With the advent of the open AIs of the world, the use cases for AI have accelerated dramatically. So, so there's a larger audience, and by NVIDIA, through the NVIDIA Cloud Partners Network, supporting companies like Firmus to stand up, it means that the market can move a lot more quickly. And so, with access to the chips, access to finance, there's a huge piece of the financing, which is debt. These new AI factories, these new AI compute models will mean that there's a whole lot of other customers that, without AWS and these global cloud providers being the beneficiaries, now, for the first time in Australia, ultimately when Firmus is listed, you're going to have that, I guess, exposure for investors directly available. So if you were to ask 10 fund managers in Australia, how do you get AI exposure? They'd all say NextDC, Infratil, maybe Technology One. Forget about that. This is AI infrastructure at its core. So what that's going to do is it's going to open up capital markets. All of this is good for NVIDIA, obviously, who then uses that capital, by facilitating the capital markets with their networks, then obviously more chips get sold. So, there is a circular relationship here. I think it's great for us as investors to be on this train very early, because as long as that demand for these new AI models keeps coming, there's so many opportunities for Firmus to continue to grow and scale.
And one of the criticisms of data centers, or certainly AI data centers, is potentially how big an energy chewer they are. So two parts to the question.
Yeah.
How does the Firmus technology stack up from an energy perspective? And then there's also real concerns about bottlenecks in access to energy as well, David. Is that something that Firmus have been able to address?
So Firmus, through using, so instead of using air-cooled, but being able to immerse the chips, their PUE or their energy efficiency is best in class. So the actual, for someone buying compute from Firmus, they're effectively, getting a lower cost of buying that compute because they're using new technologies that involve the immersion technology, right? So they also don't use water. One of the other, social licenses is, water's a major consumption because of all the air conditioning involved. Firmus uses less than 1% of the water. So here's the thing that I didn't know. Now, Tasmania is a beautiful place. We all know it rains a lot. Tasmania is basically powered by hydroelectricity.
Yeah.
They run a baseline of about 1.5 gigawatts in Tasmania, and they've got some old mining businesses or refining businesses in Tasmania who are the major baseline users of energy in that market. So when they went to the Tasmanian government and said, we can do these green AI data centers here, we can use, instead of you continuing to subsidise and provide loans to some of these businesses in Tasmania, we don't need anything from you except, I guess, a DA on the land to do the development, but also access to the electricity. They've had an incredibly positive hearing. And so the reality in Tasmania is they have the ability to scale up their hydroelectric production. So there's more capacity in Tasmania for Firmus to tap down. There's also an abundance of electricity in Australia. It's just not always in the right places, right? So when you're competing in, the suburbs of Melbourne or Sydney, against all of the other home and industrial, then you start to run into the bottlenecks. The trick for these data centers is to be as close to the source as you can, as close to the transformers as you can. You don't want to end up buying CBD locations, right? Because a lot of the models they're running, latency is not an issue. So the connectivity between Tasmania from like a cloud or internet connectivity is completely fine for the models that they run. Like you might not be, running a high frequency trading system, which requires milliseconds of latency, but for the models that you're running in AI, it's perfectly fine. And so the bottlenecks that you talk about, Firmus is overcoming them through their own technology applications. CDC, their partner, is actually opening up a large pipeline of already developed and currently being developed sites. And then, the capital markets and the finance side of it, NVIDIA's helped to unlock that by leading the investment round and bringing people like us along in the journey.
So one last question on Firmus before we change gears.
Yep.
When you purchased into Firmus, it was largely a story of an AI data centre being built in Launceston. And what I'm hearing very quickly, things have moved. And now there's the CDC, NVIDIA, Firmus, multi-city rollout of AI. So that's got to be incredibly positive for the value of the investment.
Yeah. So the announcement that they made last week about the partnership with CDC, when they were building Tasmania, that was going to be 100 gigawatts. The partnership with CDC talks 100 megawatts, sorry. The partnership with CDC is for 1.6 gigawatts, so 16 times the size. Along the way, they've added in a first site in Brooklyn here in Melbourne, which is an extra 50 megawatts. And so that first 150 megawatts will be up and running when they build Launceston, turn on Brooklyn, and that'll be functioning between now and the end of next year, hopefully soon. And Brooklyn should be up and running around about April next year. Those chips are ordered, the facility's already built. So the line of sight has gone up dramatically from, we're going to build Launceston, find some customers and be running next year. So they're going to be in market quicker. There's, because of NVIDIA coming out and announcing that they're already going to be a client, that's bringing in much, a larger pipeline of really significant new customers. So getting to that 1.6 gigawatts still seems like an awful long way to go, but the pieces keep falling into place. So, I would expect that there'll be a series of events. You'll see this quarter, the next event, which is, already been talked about in the media, the next stage of financing, which will crystallize, probably more debt, more equity, funding the build out of the more immediate pipeline. There's an IPO, which is very much in the plans for next year. I think the company's working towards an IPO, let's call it in the first half of the year. But these things always take a bit longer. But an IPO next year is very much, front and center. And so there's, I think, multiple opportunities. And you talk about our role as the investor in all of this. I'm a board member here. The company is working at hyperspeed. They've hired in a chairman who's come as a former CFO from TPG. They've brought in a CFO who was formerly the CFO for Xero. I think my role as a board member and as an investor in here is to get around, Ollie and Tim and the management team who are running at a hyperspeed, just to maintain a little bit of governance, a little bit of assurance around the financing, and also to continue to help bring people, because I'm not going to be building any data centers, but I tell you what, we certainly know the gates that you have to go through to get to a successful IPO over the next sort of 12 months.
Terrific. So changing gears, I want to talk about a mainstay of the JAADE portfolio, and I'm very keen to talk about Mable.
Yeah.
It's fair to say that Mable's been a raging success for the
Thank you.
portfolio.
Yep.
Where do things stand now with Mable?
Yeah, so Mable, in 30 seconds, Mable is a two-sided marketplace supporting people with aged and NDIS disability funding. Mable basically connects people so then they can choose what services that they want to use. So it might be, personal help, might be a child with autism who's looking for someone to do some supervision and help them with some experiences. But Mable runs a marketplace, verifies who the support workers are so the families and loved ones can, manage that relationship. And also they get shift notes about the quality of the experience. So Mable as a business continues to grow at about 30% a year. The marketplace, which is the core asset of the business, sort of sits in the middle facilitating those relationships. But they're going into a bit more vertical integration by offering in the disability side, plan management, and also coordination in the aged care side. Now, disability, as we all know, is under tremendous pressure because it's a big, cost to the overall economy. It's not about to disappear, but I think the rules are evolving. So the disability side of the business is more consolidating than continuing to grow quickly. But on the aged care side, the growth rates are going up. There's a raft of new packages which are about to be released to market in November. There's more home care that the government's looking to make available for people. And so Mable is has been building out a capability for some time around providing oversight for those packages, and also they're going deeper into helping those customers to then get the right carers, mostly from the platform, to provide those services. So Homemade, which is the brand that Mable operates under, has been one of the real success stories over the last couple of years. Over the next 6 months, you would expect to see the aged care side, which is now about 60% of Mable's revenue, continue to grow at really accelerated growth rates, 40, 50, 60%, right? And so in a business doing, turning over close to $500 million and they take about, $130 odd million of revenue, it's scaling, it's large. It's one of the largest providers, if not the largest provider of these home care services in the market. So Mable's investing heavily in the technology, the AI, to be able to make that as frictionless as possible in terms of coordinating and helping customers to get access to the care. But we've been Mable's been a cornerstone of the portfolio since we started 7 years ago. We engaged advisors earlier this year to look at what options we might have. There's been some work going on around pulling the numbers apart to sort of try to look through where we've been investing in future growth versus what the current operations are. And so we've been sort of, doing two things: educating potential parties that might be interested in either buying or strategic interest, and also preparing the way we present the company to those people when they're looking at it. I think in the short term, we're waiting to see how this next leg of growth goes with the new aged care packages. But there's a clear intent, having been there for a while, to get a little bit of price discovery. Even General Atlantic, who came in about 4 or 5 years ago, is also of a similar mind. The founders are of a similar mind. It's just that point of the journey. Is a sale, is a investment from a, private equity firm, is a potential IPO. All of these things are scenarios that are being explored at the moment. And as long as the business is performing as well as it is, we're really happy to keep all those options up in the air. And to be frank, with the capital markets the way they are, with rates coming down, people paying more money for growth assets, now is absolutely the right time for us to be in market and exploring what those options look like.
Do you see a bit of a potential runway there for Mable just on the back of, like you said, the changes of aged care rules that are coming through, the ageing demographic of Australia, and I suppose the complexity of the system?
So personally, I think this is why Mable will resonate as a listed company in Australia. I think investors in Australia understand the dynamic of the ageing population, the regime of the government. We live in the lucky country, right? And the amount of funding available for people to stay at home longer is something that's going to get, massive support, whatever side of politics you come from. So the thematics here are good. They're well understood. Mable's gone for many years being a business that was in an investment mode, then a break-even mode, and now it's increasingly profitable. I think I don't want to get off the bus as a shareholder because I see a really bright future. But I do think, some sort of transition in the ownership structure makes sense.
Yeah.
And so when I look at the quality of IPOs that have come to the Australian market in recent years, I don't think people have been, I don't think that demand has been met in terms of from the institutional investors on that side of the coin. So I think there's a real chance for Mable to make a case to get great institutional support, because this is a business that does have another long runway because of those thematics you talk about. So, and quite frankly, I think that's great for the employees. It'll be great because I think with even more access to capital, there are other areas where they can really double down, invest in those AI capabilities and continue to make sure that this is the best future-facing platform for providing those home care supports in Australia.
Maybe outside of Firmus and Mable then, David, are there any other sort of positive or negative developments for some of the portfolio companies?
Oh, there's plenty going on. Where do we begin? I mean, I think if you look at the other investments that we've made this year alone, Sleek is a business that, helps businesses, especially businesses that are starting up and, dealing with their accounting, bookkeeping and compliance. It's a business that has north of $30 million of revenues. Again, it's got scale. It's a market leader in Singapore. It's an emerging player here in Australia, and one of their founders is living down here. What Sleek does is, when you're in an accounting firm and someone comes in and says, I want to spend a little bit of money to start a new business, they're not always the best clients for an accounting firm. I know you guys might have a different view on that, but I think for these entry-level businesses that are starting out, an automated platform that's using AI to eliminate the manual requirements to simplify, they're not solving for businesses with 50 to 100 employees. They're solving for those startup type firms. And it might be a bookkeeper, it might be that, someone's a gardener. So those, they're talking to partnerships with businesses we've been involved in before, like Mable or High Pages. So for those, independent business operators, this is a really suitable platform. So Sleek's really exciting, and that's a relatively new investment. I suppose we can talk a bit about frozen yogurt as well if you want to dive into dessert. So, maybe. So Yochi's a business that everyone's, incredibly aware of. Like, I think it's one of the most popular brands. And what we like about Yochi, again, we've always had a bias towards technology businesses because we love the economics. The pattern recognition for us is always, looking for those high operating leverage, high growth rates, large market opportunities, and the frequency of and the predictability of the revenue streams. So what makes us think that moving into a quick service restaurant, again, it's about the maths. And so we can see that when they, deploy money into one of their new stores, that they get paid back in less than a year, which is twice as fast as, a Guzman and Gomez or some of the other listed restaurants. We love the fact that in Australia, they maintain a very strict focus on those AAA locations. So, when you go to Brisbane, when you go to Adelaide, there are stores there, and we've sort of reached out and done a lot of research. During their busy periods, there are lineups for people going into these stores. And anyone who's been to the stores will know the experiences. And if you've got, kids at different ages, I think it applies to kids as much as adults and everyone. But the self-service model in there really resonates. So what that means is, you have less staff, a very uncomplicated menu. So you're not doing, breakfast, lunch, and dinner. It's the same product all day. People help themselves. And in fact, the staff who are there to make sure you have a good experience, but they're there to basically take your money. And so the margins, the payback on those stores are terrific. The fact that they've now entered the Singaporean market with their first store and been blown away by the experience they're having there, I think Asia is a incredibly immediate and attractive opportunity. And if you go back to that pattern recognition before about what are we looking for, Jeff and Janine Ellis, the founders of Boost Juice, they absolutely thoroughly know exactly what they're doing. They're very clear about, as they go into new markets, the types of partners they want, where they want the stores to be. And I think the people who work there love working for them. They've built a really positive brand. And quite frankly, this is one of those situations where, we'll be an observer at the board, but we are very much tucked in behind their operating capability. Who's for us to decide whether you put strawberries or choc chips on your frozen yogurt? We'll leave that to them. But there's very much a conversation with them where in one part of their mind they're looking at, do we want to IPO? When do we want to have an exit? So I think a lot of the conversations for us were why they wanted an investor like us is, one, it's a great proof point of evaluation to have an investor coming in and putting money into the business, and two, I think they're looking for us then to help to, make sure that they maximize their value of their business as they head towards a realization over the next few years.
Mm.
So
So it's a non-franchise model, as I understand.
yeah, really interesting. So franchise models are a great way to accelerate growth, but the paybacks on these stores are so quick that they've done it as a company-owned model.
Yeah.
So they have actually opened their first 2 franchises in markets where they felt that they knew partners who could help them to get there quickly, which was in, I think, Newcastle and Wollongong. But I think in those sort of high street CBD and metropolitan locations where they've got teams, they'll stick with the company-owned model.
And the growth story is just a continued store rollout.
So Australia is about 60 or 70 stores. And it's interesting. I spoke to, the folks at GYG. We did a bit of due diligence looking at their experience. They were trying to grow at 40 stores a year, and now they're trying to put drive-throughs in, and it's really hard to find sites, and they're into the hundreds of stores in Australia. At 60 or 70 stores for Yochi, they're looking to grow at about 20 stores a year, which is it's interesting because they want to be that premium. They obviously want to get to the market and be able to, dominate the category that they operate in. But 20 stores a year is a really solid base case. Again, I think it's the benefit of experience. Jeff and Janine, they went through it because they're owning the stores. They want to get it right. They want to make sure the maths. They know ultimately if they can maintain the maths, the value that someone will pay down the track will be because of the consistency of the performance of the business. This isn't just a flood, right? Yochi has a brand that actually stands up. And when they do go toe-to-toe, because people always want to come in and compete, they compete well because they have a brand, they have a service and a product that really stands out from the crowd. So, I think the growth in Australia underwrites our base case, the optionality with what they're doing into Southeast Asia, and potentially, they've got partnerships and plans for the US and Europe. It's just more optionality from our, without wanting to use too many dessert analogies, it's kind of like putting a cherry on top if they're successful in those overseas markets.
Great. So everything sounds very positive. I guess the question, is there are there any companies in the portfolio, David, that perhaps aren't quite performing to your satisfaction?
Yeah, look, there is. And I think, we're with 10 portfolio companies, we are in portfolio management mode the whole time.
Yeah.
So there are businesses that we're motivated to have realizations on. And so there's always 2 choices, fix it or sell it. So Prospection's one we've talked about before. And over the last year, we went through a process to try to sell the company. And in the end, one of the existing investors, Main Sequence, led around, we put some more money in and, we've extended. So that now funds the business to profitability. And there's a good story and a really good turnaround happening in the business. But I think fundamentally, we're still very motivated to sell the business. The big issue that we had when we went to sell it last year was it was still burning too much cash. So whilst there was an attraction to some of the capabilities and customers that they had, when we got down to strategic discussions with a couple of parties, they just couldn't get their mind around a business that was burning as much cash as that, which is totally rational. Yeah. So as we sat down with shareholders and management, the very clear strategy was to get the business to profitability. Now, they've continued to win clients. They needed more cash to get to break even. The cash is now there that gives them sufficient headroom, and they should be break even in the first part of next calendar year. And so we'll definitely be back in market looking what that realization looks like. But the chances of getting a good, clean exit, and again, it's a really interesting thing because one of the things as we invest in companies, that emotional connection is a situation where, the founders have put a lot of years of effort in. They've, committed capital. They actually put money in a preceding round of financing because when the company was under its maximum stress, they put their own hands in their pockets, which was really important for us. So that brought a lot more trust and conviction for us to want to extend the runway. We have relationships with these founders. It's not just a matter of us sitting there and going, nah, that's wrong, cut that cost. Yeah. We've got to work with these people to get the outcome. And that alignment of interest we talked about, Prospection's a really good example of that. They have worked so hard. They're achieving great outcomes. They've just signed their first almost $1 million annualized recurring revenue contract. There are wins in there, and I could tell you about a turnaround where you'd all go, wow, this business. The problem is when we first invested, we got our price wrong. And because we've had to put more and more capital in, we're not going to make our number in terms of the returns we want. So as far as the portfolio goes, we want to, exit and realize the position. And the beauty is we're a private company portfolio. I can be really candid about this. It's not going to be a surprise to the company. Certainly not a surprise to those companies that we're talking to about buying it. We're really clear. We know we need to walk it to that point that it's a profitable break-even business, and then we will look for the next owners. We're not going to make our money back, but, it happens in a portfolio unemotionally. Take your medicine, move on, and, and look for the next opportunity to deploy our time, energy, and capital.
Right. We're seeing sort of domestic listed markets sitting at or near all-time highs.
Yep.
What are you sort of seeing with respect to the valuation and growth arbitrage between public listed markets versus the unlisted market that you play in?
Super question. I think we don't, with our valuations, first of all, we don't follow what listed companies are do by moving them around up and down. So the kind of approach to value that we have is we kind of try to focus on what we think is the wholesale or the entry price. And then as businesses grow, we reflect a bit of the growth rates, but we keep multiples basically the same. So when markets go up and they go down, you'll sort of see the valuations going up, but that's really underwritten by the growth and the performance of the businesses. So there's definitely an element, I think, across. So globally in technology, there's a big skew towards the biggest and best and most successful companies that are driving a lot of that valuation expansion. I think overall, what I'm seeing in the market, and again, the reason I'm so confident in the volume of transactions is it starts in the US, and in the US, there's clearly an appetite for there to be less regulatory red tape, which means starting at big tech, they're going to buy more of the small tech. They're going to buy more assets in the market, and that's going to mean that people are going to be putting more capital to work and chasing. We are definitely seeing offshore buyers. We saw Accel KKR, who were the buyers of focus, buy a couple of businesses in Australia this year. There are firming up alternatives. Private equity buyers, strategic buyers, and those IPO markets. So those three pillars of sort of exit strategies firming up. I'm less, with market valuations going up, whilst there's a degree of awareness of it, the awareness to me is really about us being able to then take those companies that are the ones that we're ready to realize for maybe their maturity, maybe a little bit like Mable. It's a good time for change of ownership. But while those market conditions are good, because they haven't been good for the last few years, we're definitely on the front foot with some of those exit realization conversations. And I think if there was one thing that our team is really investing in at the moment, it's making sure that we're actually prepared. So for every company, even if they're not in process, how you prepare your financials, the quality of information, what are you doing to make sure that you've got those key metrics that investors are going to look for always improving? So I think I see that market conditions as actually facilitating us to get the outcomes rather than being something that's going to necessarily underwrite the performance of the fund. The performance of the fund, which I think is going to continue to probably accelerate, especially this year and into next year, will be much more guided by the quality of the performance of the businesses. So in the case of Firmus, that's going to be the biggest contributor to growth, I think, this year, primarily because they've got this incredible acceleration of the sites that they open up. For the other companies that are going to be moving the valuations of the fund up, it will come from the performance of the businesses, not from the multiple expansion.
So, David, basically we're out of time. I was going to finish by saying that, since you started the fund, you've had returns of circa 15% per annum, certainly superior to the domestic market. And you've just pointed that, that the outlook looks relatively positive.
I think this year there's very clear signs that Firmus will be the biggest contributor, having had the exit of Focus and being able to redeploy and write big checks into both Yochi and Firmus. So that means, we're effectively sitting there today with over $100 million across our sort of almost $500 million in those companies. I've got incredibly high confidence about what they're going to deliver. As you said, Mabel's continues to perform well. Sleek, Fresh Clinics, and other portfolio companies are all doing a bit of heavy lifting. There are going to be some, Prospection's our smallest position in the fund these days, right? So the bigger positions are actually performing the best. So we're in a good place. I'd like to think that we can sustain a 15% annualized return for, many years to come. This year's probably a year that we'll do a bit better than that. But if we can continue to punch out a mid-teens return, that's right down the middle of the fairway for what we'd like to deliver.
Beautiful. David, congratulations on
you.
The performance of the fund to this point. The outlook looks very exciting. So on behalf of GFM and our clients, thank you for your outstanding results. And on behalf of Sam and I, thank you for your time today.
Thanks, Paul. Thanks,
Thanks,
Sam.
David.
Enjoyed the chat.